Welcome to Cafe Mutual YouTube channel. Friends, midcap funds have delivered over 25% returns over the last 1 year and 3 year time frame. Now the question is, will the rally continue or what should you do with your midcap allocation? To answer these pertinent questions, today we have with us Rupesh Patel, Senior Fund Manager, Nippon India Mutual Fund. Rupesh has over 25 years of experience in fund management. And incidentally, his fund, Nippon India Growth Fund, has completed 28 years. So we will talk about the fund as well. But before moving on, let's welcome Rupesh. Good evening, Rupesh.
Good evening, Nishant. Thank you so much for having me on the show.
Great. So, Rupesh, my first question to you is that you know that mid cap funds have rallied, in fact, in the last 1 year and 3 year. So they have delivered over 25% returns. So I want to understand that how will the segment perform going forward and how comfortable are you with the valuation of mid-cap companies?
Absolutely, Nishant. I think it's a very valid question considering the kind of rally which we have seen, particularly in mid caps, small caps. Many investors tend to think that markets have already given this much return, so how much more returns you can expect. I would like to make few points over here. Number one, in near term, it's very difficult to project markets. What will they do? How far they will go, and all that. And yes, after this rally, there are some pockets of exuberance in certain segments. But I believe that if you are convinced on India's long-term growth opportunity, and you are willing to live through some near-term volatility, then the mid-cap space offers an attractive segment to be in. Let's not forget that considering our longer term structural drivers like our favorable demographic advantage, trends like financialization of savings, or market shares shifting over a period of time from unorganized sector to organized sector, these are longer term structural drivers, and it will lead to a situation wherein many of today's mid cap companies will become tomorrow's large cap companies, as we have seen in the past also. There are many segments where to play in those segments. I mean, only companies are available only in mid cap space. So I think the longer term argument for investing in mid cap as a segment, that remains pretty much intact. And our approach is to look at portfolio on bottom up basis. And when we are picking up stocks, we are mindful of valuation. When we look at valuation, we do take into account the long term growth opportunity which is there in front of these names. And I think our objective is to strike a balance between a near term as well as the longer term opportunity which is there.
Okay, so Rupesh, if an MFD has a lump sum money to deploy, should he consider a mid-cap fund and for what horizon he should consider this?
So I believe when you invest in equity, irrespective of what segment it is, whether large cap, mid cap, small cap, the longer it is, the better it is for the investor. And there is enough data to prove, not only in global markets but even in Indian markets, that if as your investment horizon becomes longer, the probability of you making positive return, that goes up. And hence, my suggestion would be that don't look at equity as an asset class where you can make you quick money. You can make it quick money if you are lucky, if you get the market cycle right, or maybe few stock calls right. But look at it as a test match and not a T20, and that would be more rewarding for investors.
Great. So Rupesh, recently Nippon India Growth Fund has completed 28 years. So the scheme has seen many market cycles and witnessed changes in its mandates. So what is your one learning over the years?
I would say it always pays off to be patient and not necessarily carried by near term euphoria or despair which comes in the market. So thinking long term at the point of extremes, particularly, I mean, that really helps for longer term returns.
Okay. The scheme is among top performers in generating alpha for investors over the last 5 years. So what has contributed to this performance, Rupesh?
Fund has done a phenomenal job in terms of delivering returns, compounding investors' money at 22% CAGR over this journey of 28 years. And few things I would attribute it to which has worked for this fund is number one, our focus on bottom-up research. That's one big area of strength which we consider for us. So bottom-up stock picking, risk management framework, which has helped the fund seen through the cycles. And finally, I would say the ability to balance between achieving right diversification and at the same time backing our high conviction ideas with right weights in the portfolio. So I think it's combination of these three things: focus on bottom up research, risk management framework, and attaining right balance between backing our high conviction ideas and having right diversification in the portfolio. So these are three things which I would say has worked for the fund, and as a result, fund has delivered what it has done.
Rupesh, despite being a mid-cap fund, the scheme has adequate exposure to large cap companies. So, what's the reason for this?
So again, I would say very good observation, Nishant. Now, if you look at our large cap holdings, there are a couple of reasons because of which we have those holdings over there. Number one, some of these stocks which are there, when we had bought them, they were mid cap stocks. Actually, we were pretty convinced on their longer term growth opportunity. That thing has really played out, and some of those stocks have today become large cap. So even though according to the classification they have become large cap, but we still believe that the growth opportunity ahead of them is meaningful, and we would like to hold on to them, hold on to those profit pools, and that's why even though those stocks have become large cap, they are there in our portfolio. Second thing, again, if we look at the MFI classification, I mean, which we do every 6 months, wherein stocks are classified between large cap, mid cap, small cap. There are stocks, there are opportunities which are classified as large cap. But again, I mean, if we look at in terms of risk reward, in terms of growth opportunity, in terms of runway for growth, which is available to them, and valuation at which those profit pools can be invested in, there are some attractive opportunities which we do not want to ignore just because they are classified today as large caps. So these are a couple of reasons because of which we have exposure to some of the large caps in our portfolio, and I think the market cap range as a result of what we get is a very sweet spot to have in terms of investment.
Okay. So, Rupesh, why do financial services and healthcare contribute 35% of the total exposure of the fund?
So, yeah, that's right. I mean, today, if we look at our fund, then in terms of our sectoral exposures, financials, consumers, and to some extent, healthcare, if I include hospitals also over there, are meaningful exposures in our portfolio. As I said, our approach is to construct portfolio on bottom-up basis and not really being carried by the top-down view on the market or anything like that. We believe that talking about, let's say, consumption or financials, and to some extent, healthcare is kind of a consumer-focused sector over there. We believe that considering the longer-term drivers like favorable demographics, growing per capita incomes, consumption is a very structural sector in nature. Um, as our per capita incomes grow up, people will spend, people will save. So businesses that can capture this spending, this saving, I mean, are the ones which have long runway for growth. Talking about spending, as your per capita incomes grow up, trends on improving penetration levels across multiple categories, trends on premiumization will play out. I think there are multiple categories, new categories, which will get created over a period of time. So I think this is a sector, a segment where many winners for future will come from. Obviously, we have to be mindful of valuations. We have to be mindful of multiples or valuations, what we are paying today to buy into those growth opportunities. But nonetheless, I think many of tomorrow's winners will come from this segment. Similarly, if we talk about financials, then as I talked about capturing savings, so credit growth going ahead, so which means that exposure to lenders can be helpful. But if you look at our exposures, it is not only to banks, but it is to insurance companies, it is to NBFCs. Within that, we are well diversified in terms of NBFCs which are focused on rural sector, NBFCs which are focused on power sector. That's where valuations were very, very reasonable. And insurance companies, stock exchanges, distributor of financial products. So there are multiple profit pools which will gain from financialization of savings playing out. These are strong business models, and that's where we believe that there is opportunity. And as a result, on bottom-up basis, we have ended up being overweight on this sector. Yeah, I mean, so there are investment arguments for each and every company which we have in our portfolio, and it's all driven by bottom-up stock selection. So the overweight on sectors which you see, it's all a result of that's where we feel the opportunity exists.
Great. So, Rupesh, the scheme has exposure to 92 stocks. So, don't you think that the scheme is over diversified?
Again, a very good observation, Nishant. So yes, you are right. Today, if you look at my portfolio, we have about 92 stocks, 91, 92 stocks. And as we speak, we are, focusing on consolidation to little bit, but not significantly. However, I would like to highlight a point that if you look at our top 30 holdings, then almost 55% of our portfolio is invested into top 30 names, as against 20% weight, which is there in top 30 benchmark stocks. So to that extent, fund is a very good representation of our high conviction stock ideas. Second reason why you see larger number of stocks is that there are certain stocks which are in a process of being included in the portfolio, and at the same time, there are certain stocks which are in the process of being excluded from the portfolio. So that also creates a tail. And the third reason because of which number of stocks go up is that in case of, say, some illiquid names or, say, relatively smaller size names, where we like the idea, we like the opportunity which is there in front of those names. But instead of betting on a single name, we want to play it through a basket of names. So an individual stock may not have enough weightage, but that basket may have meaningful weight in the portfolio.
Rupesh, one last question. Why should MFDs recommend Nippon India Growth Fund to their clients?
Okay, actually, I would say that if you look at this fund, it has a history of 28 years. And in this long track record of 28 years, it has gone through multiple cycles, both in the market as well as in the fund's performance. But every time it has come back strongly, which is a testimony of our focus on research, our risk management framework. And I believe that, with a fund which has such a long track record, has been through such, multiple cycles, there is no reason to believe that why it will not stand out for next 28 years as well. So I would say, look at the longer term track record, look at the risk management framework, focus on research. I think these are some of the strengths because of which investors should consider this fund. Our track record of compounding investors' money at 22% over 28 years, at more than 20% over last 10 years. I think that itself is a testimony of our processes. So, yeah, I think these are some of the reasons because of which this fund should be under consideration for allocation.
All right. So we have come to an end to this interesting session. Thank you so much, Rupesh, for your valuable time and inputs.
Thank you. Thank you so much, Nishant. Thank you so much for having me on your show.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.